Very warm welcome to Technical Analysis Session 5. And in today's session, we are going to take few more candlestick chart pattern. And of course, we are going to start with the market indicators. So I hope you remember what we had done in the previous session. A quick recap of that, because this happens to be the most important thing in candlestick chart type. So as I mentioned earlier, that this is a green candlestick chart, and it usually represents a bullish sentiment in the market. Depending upon the kind of software which you are using, it can either be white or it can be green. Okay? And even if the real body, which is this, okay, right? If it is white or if it is green, then it indicates that the market is bullish. And how do you understand that the market is bullish? In this case, you will find that the closing prices will be over and above the opening prices. This is the highest price of the day, and this is the lowest price of the day, which is what we have already understood from our previous sessions. And this is the upper wick or the upper shadow, and this is the lower wick or the lower shadow. Okay, why bullish? Because the closing price is over and above the opening prices. Okay, this is the day's range. What is the highest price and what is the lowest price? And of course, the bearish candle, that is represented by either a black real body. Okay, so this is the real body. So it can be represented by either a black real body or a red candlestick. That is a red real body. Okay, and what signifies a bearish sentiment? Of course, when the market is bearish, the closing prices will be lower than the opening prices. When the market sentiment is bearish, the closing prices will be way below the opening prices. So it is a difference between the opening prices and closing prices which determines the length of the real body. Higher the range between the open and close prices, okay, you will find that the real body is that long. If it is a very insignificant kind of a difference, which means the opening price is 50, let's say the closing price is 45, so of course it indicates a bearish sentiment. But in that case, you will find that the real body is small as compared to an opening price, let's say of 200, and a closing price, let's say of 100. So in that case, you will find that the real body is considerably higher. Of course, this is the highest price of the day, okay, and this is the lowest price of the day. This reflects the upper shadow or the upper wick, and this, the bottom part, the line which you can see, that is referred to as the lower shadow or the lower wick. I'll explain this again, and why I'm explaining this again and again is that if this part is clear, you will be able to understand the technical analysis, chart patterns, and the market indicators very nicely. Okay, so now coming to the chart patterns. So the first one which we are going to take up today is the piercing pattern. Now the piercing pattern consists of two candlesticks, as you can see over here, which suggests a potential bullish reversal. Why a bullish reversal? Because the previous candle, that is the first candle, is representing a bearish sentiment because it is having a red real body, and the candle next to it, that is the following day's candle or the following time period's candle, is green, is having a green real body, indicating a bullish sentiment. Okay, so this piercing pattern should not be used in isolation, but rather in conjugation with other supporting technical tools to confirm the piercing pattern. Okay, so the piercing line pattern is seen as a bullish reversal candlestick pattern located at the bottom of a downtrend, and it frequently prompts a reversal in trend as bulls have now entered the market and they push the prices higher. So the most important thing in piercing pattern is that it involves two candlesticks with the second bullish candlestick opening lower than the preceding candle. Okay, opening lower than the preceding bearish candle, and this is followed by buyers driving prices up to close above 50% of the body of the bearish candle. Okay, so the buyers have entered the market, and they ensure that the prices they close over and above 50% of the body of the bearish candle, as you can see. So they close above. You see this? They close above the 50% of the body of the bearish candle. Alright? And the moment you see this kind of a pattern, you understand that a bullish trend is likely to follow. But remember, it should not be studied in isolation, but it should be studied in conjugation with other supporting technical tools to confirm that whether a trend reversal in the form of a bullish trend is to be witnessed in the forthcoming sessions or not. Let us just have another close look at the bullish candle. So it occurs at the bottom of the downtrend, includes a bearish and a bullish candle, and the bullish candle opens lower than the close of the bearish candle, and the bullish candle then closes above the 50% level of the bearish candle, as you can see over here. So what does it tell to the traders? So potential trend reversal to the upside, okay, which means that there is a bullish reversal which is to be witnessed, and it is at this point of the time that it indicates that the bearish sellers are losing impetus at this key price level, and the bulls are about to control the market. So what is the advantages of trading with bullish engulfing candle? So it's easy to identify for both a beginner, that is a novice, and also an experienced trader. So possibility of favorable risk-reward ratios is very much there the moment this kind of a piercing pattern is witnessed, and the desirable entry levels can be obtained after confirmation of the piercing pattern. So if you get to see this kind of a pattern, for sure, enter the market, okay, and make some money. Yeah, so over here, you can see a piercing pattern chart, right? So this is a piercing pattern. As you can see, there is a bearish sentiment followed by a bullish sentiment, and the closing price of that real body of that candle, of the bullish candle, is 50%. If you see this, as I said, it has to be, it should close above the 50% level of the bearish candle. So it's closing almost 50% over the real body of the bearish candle. So this chart above shows the presence of a piercing pattern, and preceding this pattern, as you can see, is a strong downtrend as indicated by lower lows and lower highs, lower lows and lower highs. Okay, and after which, if you get to see this peering pattern, for sure from there on the markets are going to move up. So if you get to witness this kind of candles, two candles, one which is bearish, another which is bullish, it indicates that from there on the markets are going to go upwards, and that is the time to enter the and to make some good profits. Next we come to another chart type which is referred to as Harami, and there are two kinds of Haramis which we get to see. One is the bullish one and the other is the bearish. So as you can see, the highest price of the day, the opening price is reflected over here, the closing price is reflected over here, and by this is black in color, the black body, as you can see, the black real body, because the closing prices is below the opening price. The closing price is below the opening price, and this has been the lowest price of the day. This has been the highest price of the day. The next day also you witness a same kind of a trend. Okay, so market's going further down. But after that, what you get to see is some sunshine coming in the markets in the form of a bullish trend setting in, which is being witnessed by a white real body or maybe a green real body. Okay, so though the real body size is small, which means that there is a very small variation between the closing price. This is the closing price, and this will be the opening price. So though there is a very small variation in the opening price and the closing price, but still it gives that kind of a silver lining that from here on the market is going to go. Okay, and that is what you get to see. The moment you get to see this kind of a thing, okay, these two candlesticks which are bearish, and then when you get to see this, okay, the green body, green real body, okay, and of course there is a little bit of gap which is also witnessed, okay, and from there on the markets, they move upwards. Okay, so a bullish harami is a candlestick chart indicator for reversal in a bear price movement, and it is generally indicated by a small increase in price. You see a small increase in price signified by a white candle or a green candle that can be contained. Now, this is important, that can be contained within the given equities downward price movement. Okay, see, this is very much contained within the given equities downward price movement, which is signified by a black candle or a red candle from the past couple of days. Okay, so this kind of a chart pattern, it depicts a bullish harami, and the first two candle, the black candles, they indicate a 2-day downward trend in the asset, and the white candle or the green candle, it represents a slightly upward trend on the third day, which is completely contained by the body of the previous candle. So if investors, if they get to see this bullish harami, they may be encouraged to see this kind of a trend, and it usually signifies a reversal in the market. And if it is seen, it means it's time to enter the market. So this is what you see over here. As I was saying, this is a bullish harami. As you can see, the previous 2 days, black body, and after that, there is a small white body which is witnessed at the bottom of a downtrend. So this acts as a kind of a silver lining, which indicates that from here on, the bulls have started entering the market. They are seeing a positive sentiment existing in the market. They enter, and from there on, if you look at the trend, it goes right. So you have to be very careful while you are seeing this kind of a pattern, that it should be happening once when the market is towards its downtrend. And after that, so you just see the immediate 8 days candles, which are black, followed by a white candle having a real body, and a major part of this real body is being contained by the previous day's black body, right? But since it is white, it indicates that the markets from here on is likely to be bullish, and from there on, as you can see, the prices are going. So a bullish harami indicates a trend reversal, and from there on, the prices, they go upwards. Uh, Now, as you can see, again another chart to explain this. Look at this. The prices are coming down. You see lower lows. Okay, the prices has hit the rock bottom. 2 candlesticks before this white real body or green real body, as you can see, okay, is bearish in nature. Okay, right? And then you get to see this green candle at the bottom of this particular downward, right? And from there on, you see that, you know, the trend is usually bullish in nature. So you get to see a reversal trend. It is from this place. So the moment you see this pattern, okay, do you see this black box over here? So which is containing a red candle and a green candle. So if you get to see, and before this red candle also, that is the bearish candle, okay, you were seeing that there was also a bearish sentiment existing in the market, which is being reflected by a red real body, which means it's a bearish sentiment. So before this, there is a bearish sentiment. This is also indicative of a bearish sentiment. And after that, you get to see this, this white body or a green body, as in this case. And from there on, it's like no looking back. And from there on, as you can see in this particular chart, the overall trend is upwards. The overall trend is upwards. Okay, so this is an example, or this is a representing a bullish chart type. Next, we come to the bearish. So it's just the opposite of the bullish, and a bearish harami is a two-bar Japanese candlestick pattern, as you can see over here, that suggests price may soon reverse to the downside. And the pattern consists of a long white candle or a green candle followed by a small black candle or a red candle. So a white candle or a green candle followed by a black candle or followed by a red candle. Right? So the opening and closing prices of the second candle must, must be contained within the body of the first candle. That is what you see. You see this? The opening price and the closing price of this bearish candle is very much contained in the previous days or the previous trading session real body, right? So as now the bearish harami pattern is indicative of a reversal pattern appearing at the top of an uptrend. So it was an uptrend, as you can see. It's an uptrend, and from there on you are witnessing these two candles, one which is green, other which is red in color, and the small black candle or the small red candle is being contained within the body of the first candle. So this kind of interprets or signifies that from here on the market is going to reverse, which means what? The bearish trend is likely to settle. Okay, the market is going to settle into a bearish trend. Right? So the bearish harami pattern is a reversal pattern appearing at the top of an uptrend. Appearing at the top of an uptrend. Top of an uptrend. And as I said, it consists of a bullish candle with a large body followed by a bearish candle with a small body enclosed within the body of the prior candle. Do you see this? The real body is very much enclosed or contained within the body of the first candle. And as a sign of changing momentum, the small bearish candle gaps. You see this? It gaps down to open near the mid-range of the previous candle. What is a gap? A gap is an area discontinuity, as you can see over here. It's an area discontinuity in a securities chart where its price either rises or falls from the previous day's close with no trading occurring. Okay, so as you can see, this is indicative of these two candles are indicative of a bearish harami, and they are usually observed in an uptrending. So here is the chart type of a bearish harami. As you can see, market is going up, and then you see this green real body followed by a red real body, and this red real body, as you can see, is very much contained within the previous day's the previous day's candlestick, which was green in color. So it's very much contained. This small real body is very much contained in the previous day's candle, which was bullish in nature. And from there on, since it is observed at the very top of an uptrending market, okay, very likely that from there on the markets are going to fall down. So you see the fall. The markets are falling. The markets are falling. Okay, so this is indicative if you get to see these two kind of a chart pattern. Okay, and to confirm it, just see what is the kind of candlestick which is seen in the very next day. And if that is bullish, if that is bearish, then it kind of indicates. So if you see the immediate candlestick type at the after this bearish rally, if that is also bearish, it kind of confirms that definitely the market from there on is going to go down. And that is what you witness over here. Okay, the candle after that, after this small real red body, okay, we see that after that also the candle was bearish in nature. And look at the real body now. Look at the real body of this candle. Look at the range between the opening price and the closing price. The range is quite big, which indicates that from here on the sellers have started dominating the market. And from there on, the prices it moves. As you can see. Again, over here, another example of a bearish rally. You see it's in the uptrend. This candle is confirming that a reversal is going to happen, and that is what you witness. So you have to see, so this is usually to be observed in an uptrending market, okay, a white candlestick followed by a black. And as you can see that the opening and closing prices of the second candle must be contained within the body of the first candle, right? And after this, if you get to see another black candle, it kind of confirms that for sure that from here on, bearish sentiment is likely to continue. And that is what you get to see in this chart, that the market moves downwards, right? So it indicates that the short sellers, that the sellers are dominating the market. It is indicating that the sellers are dominating the market, right? Coming to again bearish rally, you get to see again another chart line. Okay, now we move to another chart pattern, which is bearish star. Okay, so in a bearish star also you get to see two candle patterns. The first candle is white in color, and the second candle's real body, it gaps away from the first candle's real body. So the second candle has a small real body, okay, and a bearish star is observed in case of an uptrend. Okay, as you can see over here, that a bearish star, okay, is observed in an uptrend. Okay, and the moment this kind of a pattern is observed, it is very much evident, or you can be sure that from here on the market is likely going to reverse, and the market will be moving downwards. So whenever it is observed, it indicates of a bearish reverse. That is what you need to see. But how to actually confirm it? You can confirm it by looking at the candle immediately after this second candle, okay, which had a small black real body, or it can be a green real body, okay, and just look at the gap. Just look at the gap between the previous candle and this one. Okay, so the second candle's real body, as I said, the second candle's real body, it gaps away from the first candle's real body. And after that also, if you get to see a black body, that which is indicative of a bearish sentiment, it is very much understood that from there on a downtrend will likely to, or a bearish reversal is likely to happen. Coming to another chart pattern, which is the bullish star. So you can see again there are two candles which has to be observed. Okay, so the bullish star is a two candle pattern. The first candle is a bearish candle in line with the downtrend, as you can see over here, right? And the second candle's real body opens lower, as you can see, it opens lower. Okay, it opens lower and gaps away from the first candle's real body. You see it gaps away. Okay, right? Here also, if you see the pattern, look at the gap. A very significant gap is observed, which means that this is the time once when the market participants are sensing or are waiting for some kind of a news to come into the market. Okay, and that is why you generally get to see a gap, not much of a trading happening. Okay, all right. So the second candle's real body, it opens lower, as you can see, it opens lower. So this is the opening. This is the opening, and it opens lower. It opens lower, okay, and gaps away from the first candle's real body. Okay, and the real body is usually very small. Okay, which kind of indicates that there is a small gap or a very small variation between the opening price and the closing price. Whereas in this case, you see that the real body is very is big, which indicates that there is a huge difference between the closing price and the opening price. But here you get to see that the real body is small, indicating that the the difference between the opening price and the closing price, the gap is reducing, the range is reduced. And it is at this point of a time that you get to understand that from here on the market might move upwards, the market might move upwards. So a bullish star is seen, as you can see over here, a bullish star is seen in case of a downtrend. Okay. And from there on, you just see the next day's candlestick. So if you look at the next day's candlestick, what is it you see? That the opening price and the closing price of the next day are above this real body, okay, of the second candle which was witnessed, okay, and from there on. So if you see, the highest price is also comparatively higher with respect to the previous day's candle, and look at the lowest price, that is also higher. So in this case, it is very much certain that from here on that the prices are going to go upwards, and thereby you see a trend reversal. And what kind of a reversal? This is indicative of a bullish reversal from there on. So a bullish star is seen in case of a downtrend, and whenever it is observed, it indicates a bullish reversal from there on. This is what you are going to see over here. Right. Next we come to another chart pattern, which is evening star. So evening star is a bearish candle pattern, as you can see, and evening star is a three candle pattern. Okay. So the first candle has an open real body, which can be green, which is either white or green, okay, which is in line with the uptrend. Okay, you see this uptrend, it is in line with the uptrend. All right, and the second candle which you get to see, the second candle's real body, it gaps away from the first candle's real body. Okay, right, as you can see over here, it gaps away, right, from the first candle's real body, and the second candle, it has a small real body. And after that, the third candle, which is filled, or I mean, as in filled, as in it's black in color, and closes well into the real body of the first candle. That is what you get to see over here. Okay, this candle, that is the third candle, is of course bearish, and it closes well into the real body of the first candle. And this evening star is usually observed in an uptrending. So the moment you witness this evening star, which comprises of these three candles and are having these kind of features, for sure that from there on the market is going to move downwards. And this is what you get to see in this particular chart. So it is observed in an uptrend, and the moment it is observed, it is very much understood that from there on a reversal is going to happen and the market is going to move downwards, or the bearish trend is going to settle in. That is what it means. So this was evening star, which comprises of three candle pattern. Next, the one which we are going to take is the morning star. So morning star is very much opposite to your evening star. But here also there are three candlesticks to be seen. But the most important thing over here is that whenever you get to see a morning star, it indicates a bullish reversal. So it confirms that a reversal is going to happen. And what kind of a reversal? It is going to be a bullish reversal. And that is why the name morning star. Alright, so a morning star is a visual pattern again made up of three candles, okay, 1, 2, and 3, and a tall black candlestick, a smaller black or white candlestick. So this can either be black or it can be white candlestick, or so to say a red or a green candlestick with a short body, that is a short real body with long wicks, and the third tall white candlestick. Okay, so the middle candle of the morning star, it captures a moment of market indecisiveness where the bears begin to give way to the bulls. So just look at the range, it's small. So the bears are now giving way to the bulls. And the third candle confirms the reversal, okay, and can mark a new uptrend in the market. So the first candle, as you can see over here, the first candle has filled real body, which is in line with the weak trend. Of course, if you can see this chart as well, it is also reflecting the same. Okay, so the first candle, which is bearish, okay, it is in line with the weak trend. Look at the weak trend, the weak trend. Okay, and the second candle, its real body, it gaps lower, as you can see. Do you see this? It gaps lower, okay, in this chart, okay, away from the first candle's real body. And the second candle, of course, has a small real body. So the color of the body can be white, as in it can be red, or it can be white or green. So the second candle has a small real body, which is more important. So here the real body should be small, immaterial of the fact whether it is black or white, that is green or red, as case may be. Okay, and the most important thing is that the second candle should have a small real body, and the third candle should be, of course, bullish in nature, and it finishes well into the real body of the first candle, as you can see. So the third candle is bullish in nature, and it finishes well into the real body of the first candle. So it is usually observed, this morning star is usually observed in a downtrending market. And after it is observed, you have to look at the candlestick, which happens at the very next day, which kind of confirms whether the trend is going to go upwards. And as you can see, the highest price is much higher than this white candle. The lowest price is also much higher than this candle. Okay, and of course the body over here which you get to see is black in color, which means that the opening price, or you can say the closing price, is below the opening price. But look at the real body; it's very very small. But look at the highest price, look at the lowest price, and look at the opening price also and the closing price also. Okay, so which is again far more above than the previous day's candle, or that is the third candle, which kind of confirms that from here on the markets are likely to go upwards. So you see, after this is observed, after this morning star, these three candles are observed, And with this kind of a chart type, okay, or a candlestick type, or candlestick pattern, which you can see, from there on, the markets are moving. So look at the trend. After star, okay, which is a silver lining in this downtrending market. From there on, you get to see, and after this kind of a confirmation, you get to see that the markets are moving. Right? So now we move to a very important segment of our technical analysis, which is market indicators. So all these chart patterns, candlestick chart patterns, which we had studied in all these sessions, that gives a lot of inputs with reference to the market. Whether the market is going to be bearish, or the market is going to be bullish, or whether it's time to buy, or whether it is time to sell. All right. But there are other indicators which broadly captures the market sentiments, and they are more specific. Why? Because you can consider not only the prices and the volumes, and of course, with the help of these market indicators, you can really gauge which direction the market is moving and what is the most appropriate time to buy and what is the most appropriate time to sell. Right? So, this kind of an understanding, this kind of an analysis can be very specifically, very precisely by looking at the market indicators. So there is another group of technical tools which is designed to help investors gauge the changes in the asset classes within a specific market. And these indicators are referred to as market indicators as they gauge an entire market and not just the individual share. So the market indicators, they typically analyze the stock or the futures or the commodities, any asset classes, even the exchange rates also. And they add significant depth to the technical analysis as they contain much more information than price and volume. So a typical approach to use market indicators is to determine where the overall market is headed and then use the price volume indicators to determine when to buy or sell an individual share. Right? So over a period of time, the capital market has actually witnessed several market indicators, and some of them are so specific and so important that if you get a good understanding of it, you exactly will be able to comprehend or devise your own strategies as to when to sell and which direction the market is likely going to move from there on. So the very simple and very one of the most oldies or oldest technical indicators is the moving average. So the simple form of a moving average is known as a simple moving average. So it is calculated by taking the arithmetic mean of a given set of values. Which values? The prices of the stock or commodities or currency. Okay. So in other words, a set of numbers or prices in the case of financial instruments are added together and then divided by the number of observations in the set. So that gives you an average. Okay. You get the mean of the prices. Okay. And the moving average is a simple technical analysis tool. So the moment you get that mean, you then try to figure it out, in that entire pattern, entire chart pattern, and see which direction the market is moving. So moving averages are usually calculated to identify the trend direction of a stock or to determine its support and resistance levels. So it is a trend following or a lagging indicator because it is based on past prices. It is based on the historical prices, and that is why it is referred to as a lagging indicator. The most common the most common time periods used in moving averages Can be 15 days, it can be 20 days, 30 days, or 50 days, or 100 days, and 200 days. So the shorter the time span used to create the average, the more sensitive it will be to the price changes. So usually if you see, the shorter span is used by the traders, whereas the longer span may be used by the investors. Okay, so the longer time span, the less sensitive the average will be. This is something which is very, very important in case of moving average. So investors, they may choose different time periods or varying lengths to calculate moving averages based on their trading objectives. So usually the short-term moving averages are typically used for short-term trading, while longer-term moving averages are more suited for long-term investments. Now here what you get to see is a 21 period moving average. So once when you are having your uh, this indicator, this trading chart pattern, so yeah, indicators. Okay, so you must be having an app, or you must, or let's say a software. Okay, wherein you will be having all these kind of an indicators, and within that indicators, you are free to choose any kind of indicators, and the most common of them is the moving averages. All right, so you can choose, as I said, a 15-day or a 100-day or a 200-day moving average. All right, so here what you get to see in this particular chart is a 21-day period moving average. You see this? This is a 21-day moving period average. So the moment you select it from your app, or let's say in the software, okay, then choose this, and then it's up to you whether you want to go for a 15 days or a 200 days kind of a moving average. And this, you see, this is a 200-day period moving average. So here what you get to see is, longer the moving average time period, this kind of smoothens. It gets more smoothed. And if it is of a smaller duration, you find that you get to witness more spikes, and it's not that smooth as compared to the 200 period moving average. So the choice is yours, what kind of moving average you want, as in terms of number of days, right? Now, rising moving average. So as you can see over here, whether it is a 21 period moving average or a 200 period moving average, how will you use it for your decision making? So a rising moving average, it indicates that the security is an uptrend. You see this? Rising moving average. But remember, this is 200 period moving average, and it is indicating an uptrend. Okay, here also in a 21 period moving average, you see an uptrend. You see an uptrend. So the markets are going upward. So this moving averages, they show which direction the market is broadly trending towards. Now, if you get to see, or if you get to take a 200 period moving average, as you can see, the curve is more smooth, whereas in case of a 21 period moving average, you can see more peaks and drops over here, and it's not that smooth as compared to 200 days. So the shorter the time period, that is more so used for a trader, and the longer moving average is more conducive for an investor. So a rising moving average indicates that the security is in uptrend, while a declining, you see this, it is declining. The 200 period moving average, which is declining. Here also a 21 period moving average is also declining. So while a declining moving average indicates that it is in a downtrend. So similarly, an upward momentum is confirmed within a bullish crossover, which occurs when a short-term moving average crosses over a long-term moving average. This is what it is, a short-term moving average. Once when it is crossing over a long-term, do you see this? 21-day period crossing over the long-term, which is 200. Okay, it indicates a bullish sentiment. So an upward momentum is confirmed with a bullish crossover, which occurs when a short-term moving average crosses above a longer-term moving average. Do you see this? 21-day period moving average crossing crossing the 200 period moving average. And it is from there on, the moment it crosses, you get to see an overall uptrending and upward momentum in the market. Conversely, a downward momentum is confirmed with a bearish crossover, which occurs when a short-term moving average crosses below a long-term moving average. A short-term moving average, this is 21 days in this case, okay, it is crossing below a longer moving average is this. Short-term is crossing, a short-term moving average is crossing from below, and it indicates somewhat a downward momentum. So that is what you get to see. In some cases, it is very, very specific, right? And so this is broadly, it indicates the moving average, whether it is an uptrending market or a downtrending market. And if you are having these two kind of a smaller moving average and a larger moving average, it kind of gives you a better clarity whether the market is going upward or the market is going downwards, right? Now, another thing which you get to see over here from this chart is that the basis of interpretation of this can also be taken whether to buy or whether to sell. So the basis of interpretation is to buy when the share prices moves above its moving averages. Do you see this? So let's say a 200-day moving average. 200 days. Assuming that this is a 200, let's take this 200-day moving average. Okay, so the basis of interpretation is to buy when the share prices moves above. Do you see this? The share prices are moving above its moving averages. So 200, the share prices is moving above. The share price is moving above the 200 period moving average, or even the 21 period moving average. You see this? The share prices are moving above even not only the 200 moving average but also the 21 period moving average. What does it indicate? It's the time to move. And if the share prices, if and when you and to sell when the prices move below its average. So you see this is a 21-day moving average. So if the prices are moving below, this moving average, then it's better to sell. So here we are taking the 21 period moving averages. Okay, we are taking a shorter duration, and this is more to be taken by the traders. Okay, here also if you see the prices have moved below, okay, the 200 period moving average, which means at this point in time it is better to sell. Are you getting this? Okay, here if you see, what you see, the prices have moved below not only the 200-day moving average but also the 21-day moving average, which means a downward trend is likely to be seen, and that is the time to sell. So the basis of interpretation is to buy when the share prices move above the moving averages, and to sell when the prices moves below its moving average. Okay, so the 200-day moving average, it shows the overall trend of the market, and when the price is above this moving average, the overall trend tends to be up. As you can see, prices are over and above this particular moving average. It indicates that the overall trend is an upward trending market. And when the price is below, it below this particular moving average, that is 200-day moving average, the price tends to be in downtrend. And since the current price is lower than the 200-day price average, it is very much conclusive of the fact that the market is trending downwards. Okay, so the 21-day moving average, it shows the short-term trend capturing the smaller price range. Right? So a trader may only wish to buy when the price is above or close when the price is above, as you can see. So a trader may only wish to buy when the price is above, as you can see, this arrow, the price is above or close to the 200-day moving average. So in this way, the longer term moving average acts as a filter, helping the trader to only trade in the overall trend direction. Okay, and the 21-day may help by with determining short-term trading opportunities, such as getting in or maybe getting out of the trade. So it is more so suited for, you can say, maybe for speculators or for the traders per se. Now, what is exponential moving average? So it is again like a simple moving average, but in exponential moving average, the major difference is that it gives more weightage to the recent prices, okay, in an attempt to make it more responsive to new information. Okay, so the calculation for EMA puts more emphasis on the recent data points. Okay, and so it gives more weightage to the recent data points, and that is why exponential moving average, it brings out the market sentiments more precisely and more specifically. So EMA has a higher value when the price is rising than the SMA. So in this case, if you see, EMA is represented by green color and the SMA, that is the simple moving average, is expressed by the red color. So as you can see, the EMA moves sharply. You see this? It goes up, it comes down, again it goes up. Okay, so EMA moves sharply, okay, sharply lower as in this case, but SMA, which is reflected by this red line, it slowly worked its way lower. So where do you see that the information is more faster? It is in case of your exponential moving average. Why? Because it gives more weightage to the very recent price data, right? So EMA, which is reflected in green, it moved sharply below in a downtrending market. As you can see, market is trending down, EMA is moving down also sharply as compared to the simple moving average, which is reflected by the, and you can see that the simple moving average, it slowly worked its way lower. But where do you find the movement to be more precise? It is in case of EMA. And again, once in case of an uptrending market, that is also reflected by EMA much faster. So do you see it was going down, EMA is going down, but from here on you get to see that there is slightly an upward movement. Okay, just look at this. There is a slight upward movement. Okay? So the EMA turned up well ahead of SMA and so whenever you go on to take any decision, it's better to, this is especially for the traders, it's better to look at the exponential moving average rather than the simple moving. Okay. So the moving average chart types, as you can see in this particular chart, the chart above shows a 150-day exponential moving average of the stock, right? And this example of this chart type, it shows how well moving average it works when the trend is strong. When the trend is strong. So here it's moving upwards. So the 50-day EMA turned down somewhere in in November 2007 and again in January 2000. And the 50-day EMA turned down in November 2007 and again in January 2008. So notice that it took a 15% decline. It's moving down, it's moving down. EMA is moving down, it was going up, right? It moved down. Okay, so this down movement actually reflected a 15% decline to reverse the direction of this movement. So these lagging indicators, they identify the trend reversal. So the moment EMA is moving down, it is understood that the market is going to move down. Okay, so these lagging indicators, they identify trend reversals as they occur at best or after they occurred at whatever the case. So here also if you see, again in this case, okay, somewhere in 2009 April, okay, what is it you get to see? The market was, from here only, it was moving down. The EMA was moving down. And see, the price is actually, as the EMA is going up, okay, from here, so you see that from here on, the moment it is going upwards, as you can see, just look at this. The moment it is going upwards, it move down, and from here on, as you can see, it is going up. Okay, so from here on, as it is going up, it is reflecting that the market from here on is going to advance, which means a reversal bullish trend will be observed. And this is the time to get into the. Okay, so you can see that 40 to 50% advance. So this is how your moving average can be used not only to see which direction the market is trending, but also it helps you when to enter the market and when to exit the market. Okay, so here is the time not to enter. Okay, and here is the time when you should enter. So the moment the EMA is moving upwards, it indicates it's time to enter. And the moment it is going down, it indicates that a reversal, bearish trend is likely to occur, and better to refrain yourself from entering into the market because you don't know what is going to be the support level from there. So this is how moving averages are broadly used for your decision making. Okay. So moving averages, they also highlight the support trend and the resistance. As you can see, this particular moving average is flattish for a considerable period of time and it's below the prices. It's below the prices. This moving average reflected by this blue line is well below this kind of the prices. The moving average reflected by blue line is well below the prices, indicating support. Okay, support in an uptrending market. Prices are going up. This is kind of expressing support in an uptrending market. Why? Because MA, as you can see, that is a moving average, is below this uptrending market. So it is acting as a support. Whereas in this case, if you see over here, the moving average, as you can see, this is indicating. So this is again a support, but over here it is indicating a resistance in the down. And the moment it is observed, as you can see, it's going up and then it starts falling. Okay. The moving average starts falling after this long overhaul increase. Okay. Okay. After that, the moment it starts falling, it indicates that the stock has reached its resistance and most likely from there on it is going to fall. So moving averages can also be used as a very important tool to see whether the market, what is the support level and what is the resistance level. Alright? So what are the limitations of moving averages? See, they are calculated on average historical prices, as you can see. And this average may not provide the predictive insight in terms of where the price is going to move next. So the moving average is a lagging indicator, which means it is following the prices and moving only once the price itself as already. Only if the prices are moving averages will. So the limitation broadly is that since it follows the historical prices, since it averages out the historical prices, it is not predictive, okay, enough that from there on which direction, what is going to be the next price. So there are other indicators also which captures this particular limitation and which will also be in a position to tell you that which direction the prices are going to, right? So we are going to see such other leading indicators in our forthcoming session. So for today, I think you have got enough of inputs in terms of candlestick chart types and of course the one market indicator which we have started off today, that is moving averages. Thank you.